Hello, everybody. My name is Michael Duke, and this is the channel where we look at markets. So, if you like markets, then consider liking this video and subscribing to the channel so you see more. And yes, for those of you who are wondering, this is the format, a screen capture. Today, I'm going to be talking about the S&P 500. Notably, I'm going to be taking a very technical view of the way that the chart looks and why I think it's notable and worth paying attention to. We're not just going to be taking a look at the S&P 500. We're also going to look at the Nasdaq. Okay. So without further ado, let's jump into it. So first off, if you've been paying attention to the financial media over the last month, you might think that the sky is falling in stock world. The S&P 500 is down 5.2% year to date, not exactly a market crash. Zooming out to a year, up 6.25%, 120% over 5 years. However, things are different than just a typical sell-off in certain ways because the market expectations of our politics, of our treatment of businesses, of tariffs, inflation, all that, expectations are all jumping up all over the place. You see that with, business confidence being exceptionally low right now. Inflation expectations are all over the place, and they're even politically charged these days. The PCE came slightly over consensus, 10 basis points above consensus, both year over year and month over month. Okay. That type of print, of course, has roiled markets for the last several years, as it should. Interestingly, yields are down today, even though inflation numbers are up. So, what I see is a lot of fear in the stock market. What I wanted to discuss is apparent on this candlestick chart. So, here, each of these candles is a day. Okay. So we have in blue is the 50-day simple moving average, and the yellow is the 200-day simple moving average. And this is the S&P 500. This is about a 10-year horizon here. But one thing I wanted to point out, a couple things. First off, our moving averages have not crossed. Again, it's in terms of dailies. Obviously, when the moving averages cross, it's typically a pretty bearish sign, even albeit temporarily. Here, that didn't happen because the COVID crash was so short and there was a massive rebound due to stimulus partially and, just speculation. This period here in mid 2015, we did see about a 10% decline after the moving averages crossed, or just about correspondingly there. But it's not just the moving averages crossing. Here's the global financial crisis right here. It's not necessarily just the moving averages crossing that is bearish, but also the moving average as a point of resistance. Okay, so what I want to highlight is this. So this is in 2022. You see here, our price broke out below our 50-day average, dipped below the 200-day average, recovered somewhat. But then once we had crossed here, the 200-day moving average kind of acted as a line of resistance. Now, if you understand how moving averages work, you know that there's a bit of time lag in those numbers, and it's not an exact science. But very clearly what we can see here again is the moving averages crossing is basically an indicator that we are in a downtrend, even temporarily. Obviously, this being a short downtrend here, a very, very temporary downtrend, the moving averages did not cross. Okay. But what I see here is that since the bottom right here, the S&P 500 has more or less been in an uptrend. Here we broke down somewhat, but recovered here, continued to go. Now what we're seeing is we've broken out below that and, traded up to 5,800. And now the downtrend is basically confirmed by this movement. We gapped up here, but now we've, kind of hit this wall right here. So in other words, what I'm seeing is the price start to move down and our price bounced here. I expect further downside in the broad market. There's no good news right now. What's the catalyst that's going to break it out? Is it tariffs going away? I mean, you see the news that's coming out about Canada basically denouncing us. Chinese AI innovations throwing shade on the AI capex. There's a lot of reasons that stocks can fall. I mean, not to mention that the valuations are elevated. So we saw a similar pattern here. You see, we traded every time we hit the trend line, failed. Lower highs and lower lows. Okay. Lower highs and lower lows. It's a very steep. Notice how the trajectory of the curve is even hemmed in a little bit. I mean, that would imply a steep, a grade of that. That's more steep than this. So that doesn't look good. All right. Let's look at the Nasdaq. Nasdaq. Not the Nasdaq Inc. No, we're looking at the SPX. Yeah. Comp. There we go. The Nasdaq Composite Index. I always think it's the QQQ, but it's this. Okay, so Nasdaq's a little worse. Of course, Nasdaq is more volatile than the S&P. Historically, we see here down almost 3 points. That's pretty big. Still up 5.6%, but year to date down 10%, more than 10%. No, that's in Canadian dollars. Sorry, I haven't adequately prepared the right symbol. So let's take a look at this now. Very, very similar looking chart. Okay. If anything, this one's a little cleaner. We see here 2022, right? First you had, see, this looks a lot more like what the S&P looks like now, right? You have this very, very sharp sell-off, far below the 200 period moving average. We don't cross until this point. That's 3 months, a good 3 months of time for when the sell-off started. Okay, we're not there yet. I think we're only about a month in to the current drawdown. Okay, but anyways, what do you notice here? You see here, right here, we have a failure point right here, right? Boom, consolidates a little bit, comes up, fails again. Here it broke out, but then it failed at the 200-day downtrend. So again, what were we met with? Lower highs and lower lows. So now let's take a look at this. Looks remarkably similar. This is the last few years. What do you notice? The price never really broke down below the 200-day moving average. Okay, here it did, but that was anomalous. Okay, so all along the way, this is clear and definite uptrend, right? Higher highs and higher lows. Okay, well, of course, we have now, February 19th is what set it off. February 19th, we shot all the way down, today being the 28th. So we are about 40-ish days out from that event horizon. Okay. So what do we see again here? This looks remarkably similar to this right here. So what ended up happening, we went from 15,000 all the way to 13,000. That was over 10% from this 20-ish here. That would place us down into this range. Okay. We have failed once again. And to me, it looks like we might be in a downtrend. Now, again, what do you notice? Steeper. This is steeper than this. It's about the same as this. We see it broke out. Okay. So while this might break out a little bit, I don't think we're returning to all-time highs anytime soon, folks. Now, granted, from this date here, this was December 2021. The next time it reached that price, December 2023. Okay. 2 years is not a long time in market land. All right. But this looks very bearish to me. Look out below. All right. So this is why I don't invest in the index, because while there is the benefit of diversification, you're more exposed, the more diversified you are, the more exposed you are to macroeconomics. Whereas if you're stock picking, you can orient the factors in your portfolio a little bit more around the micro economics that affect a particular company or the macro of that industry, market, whatever. So the stock market is exposed. The stock market as a whole is very macro, and indices are a subset of that. But when you buy a specific stock, that is micro, is it not, compared to the macro of the stock market? So Warren Buffett has made it his life's mission to compound in poor market conditions. And he's stock picking along with buying outright control positions of, taking businesses private inside of Berkshire Hathaway, right? So again, we don't really have visibility into right this second how Berkshire's public stock portfolio is performing. We see the Berkshire price. That's completely different. But I digress. Either way, what we're seeing here, and this is since Tuesday till today, we've had a couple of days of very sharp sell-off since we failed. So what we're seeing that is both in the Nasdaq and in the S&P. Maybe we should just round it out and take a look at the Dow. The Dow not up as much over the last year, up only 4.6%, but doing a little bit better year to date, down 2.25%. However, if we analyze the chart, will we find anything different? You notice here that the Dow is a little bit more low beta, a little bit more straight and narrow in its performance. It's no surprise that it should be outperforming right this second. But we see a similar pattern here, albeit a little bit more mild in volatility. Okay, clear downtrend there, similar signal, except here we didn't fail off the 200 until the third bump there. So there wasn't like a steep initial drop. It's just one downtrend. It launched immediately into that downtrend. What we're seeing here is kind of similar, perhaps. However, again, if we assume that this sell-off here is to continue, this is what our pattern looks like now. Again, that is steeper than this very rudimentary analysis, but we see this confirmation in all three of the major US indices where we're in a downtrend, what appears to be the formation of a downtrend that is narrower and steeper than this. So draw from that whatever conclusions you feel like. The conclusion that I am drawing from it is that it is very bearish looking. The extent to which, I don't know. Again, if this downtrend were to continue till August, again, that would place us in the 36s for the Dow. That's 20% lower than the all-time high. Okay, not crazy to think that we could sell off that much, especially that would be the price that we were at as recently as November 2023, and and before that, December 2021. Okay, so yeah, that's pretty much all I wanted to discuss in terms of this, is that we see a pretty bearish downtrend signal in all three of the major indices. So let me know what you think about that in the comments below. Hopefully you found this interesting, instructive. I'm sure that many of my viewers are more sophisticated at technical analysis than I am. You see how crude my instruments are. So I welcome some alternate points of view there and how I should be looking at these charts. So let me know what you think. And I'm going to make a few more videos today because I've had technical difficulties the last 2 days. So I've got some catch up to do. All right. Well, I will see you next time. Thank you and bye.